Oil technical analysis, August 19, commoditiesmansion.com. The light sweet crude market absolutely fell apart on Thursday. As you can see, there's a little bit of a support resistance area here at 90. We did test it, and we did say something about the possibility of a pullback because of this shooting star. Previously, though, with this hammer, it looked like it might be a long, slow chop. We made a significant move to basically test the 80 level, just a bit shy of it. We're closing towards the lows, though, and that's never a good sign. This bar here, this hammer, if the bottom of that gives at 75, we are going much, 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 much lower. So we have a little bit of a line in the sand between 80 and 75, but the truth is, with this type of technical setup, it looks really, really weak at this point in time. With it closing at the end of the session, or at the end of the session towards the lows, that is not a good sign either. Looking at the Brent markets, you can see the same pattern. Although in the Brent markets, we actually had a spike in volume, which gets us out of this market completely. We are no longer willing to risk it, as this is a very, very bad reversal sign. Of course, we have to break below the hammer, just like we do in light sweet crude, to really get bearish to this market and start selling it off with some ferocity. But the way that the move on Thursday happened, it's very possible that we may see that test on Friday, if not Friday and Monday. What did move both of these markets, at best guess, from what we are seeing around the world's financial markets, is the Philly Fed Manufacturing Index number came out on Thursday in the United States at negative 30.7. It was expected to be positive 4. The reading is a measurement of manufacturing in the Philadelphia region in the Federal Reserve System. So it's basically the Northeast, X maybe New York, and as such, it's a pretty significant chunk of one of the most highly populated parts of the United States. And if manufacturing is really contracting that much, that shows signs of real economic weakness. And of course, Brent got really whacked for that because Brent is more well known as a energy source for heavy. It's a heavier oil, so it's known for power plants and things like that. And of course, manufacturing uses a lot of electricity. But when they're not manufacturing, they won't need as much electricity, therefore not need as much oil. Because of this, we feel that we may possibly see a bear market form. It would be under $100 though before we'd start selling, and in the meantime, just see things as too volatile, and we need to step away for a few days, let the market prove itself in one direction or the other, and then get involved.